Hello, everybody, and welcome back. So today my guest is Sam Bentley. Sam is the client portfolio manager for the emerging markets team at Eastspring Investments. And today we want to talk about recent developments for emerging market stocks. Welcome, Sam.
Thank you.
Sam, high US dollar, rising interest rates, that is not typically a good combination for emerging market stocks. So what impact does the current environment have on emerging market equities?
Well, I think historically we've seen some different outcomes for emerging markets when we've had these high dollar, high interest rate environments. But we tend to think about this very much from a stock specific angle. But having said that, if we look at recent history, we've seen a couple of periods that have actually seen higher inflation, higher interest rates that have been quite supportive for emerging markets, namely the 1970s and more recently in the first decade of the 2000s. So in terms of the current environment, we think it's still quite supportive of emerging markets and value investing in emerging markets. We saw a decade, that last decade of markets seeing underinvesting in the real economy, the global supply chains were aligning to China, a very narrow focus on digitization. So we now have a lot of structural supply chain issues we have across industrial and commodity complexes. And that combined with the monetary fiscal stimulus we've seen post-COVID, we think is driving us into a prolonged period of inflation and higher interest rates. So we think going forward, we're going to be seeing more capex in the real economy. We're going to be seeing a focus on decarbonization, less on the digitization side. Again, which we think is supportive for real assets, we think it's supportive for emerging markets, and we think it's supportive for value investing as well.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So especially last year, the topic of style rotation from growth to value was often discussed. So what is, if any, is the optimal investment style in emerging markets today?
So first of all, we don't time styles. We think this is a very difficult thing to do. And of course, as value investors, we're believers in value through the cycles at different stages in the cycle. But if we think about the last decade, we're very much in an environment where growth and quality perform very well. And investors paid high prices for these sorts of attributes, which actually implied extremely strong future growth. People made money this way, but this has created a new, very extreme distortion between quality and value and between growth and value stocks. And we've seen this starting to unwind in the last 2 years. And just in that 2-year period, the emerging market value index has outperformed the emerging market growth index by 24%. But despite this relative price correction, the decade that it took to create this mispricing is still not unwound. So the distortions are still there. Value stocks are still very cheap relative to growth and quality. And as I said before, the outlook is very supportive for value. So we think it's a great environment for value investing.
The terms value and growth are often not very clearly defined. So what makes an attractive value stock in emerging markets for you?
For us, value investing is all about trying to identify shares that have been mispriced today due to the behavioral biases and emotional decision-making of the market as a whole. So when faced with negative news, negative near-term news, investors tend to overreact, tend to oversell stocks due to their emotional and behavioral biases and simplistically the fear. This combined with this short-term focus creates a pricing opportunity for us. So we believe that if we can take these emotional and behavioral biases into account, trying acknowledging that we're susceptible to these same biases, we can try and minimize those in our process, and we can try and capture those mispricings in a structural way, in a long-term way over the cycle, and try and make money for our clients.
Emerging markets are often described as primarily offering economic and demographic growth potential. So what are the long-term arguments in favor of a value approach in emerging markets?
Yeah, the economic and demographic growth potential is really undeniable, but what we as investors are trying to do is trying to make our clients money. And it may sound a little simplistic, but to make clients money, we need to sell the stocks at a higher price than we buy them. So our focus is very much on finding stocks that have discounted future earnings potential, whether they're growth, their quality, or other attributes. We don't mind. The problem with being focused on one style, whether it's growth or quality, and then just paying the price for it, is that you need eventually to sell that to somebody else with a higher view, or a more optimistic view of the quality or the growth characteristics of that stock. And we think that is a dangerous game to play and potentially puts client capital at risk.
China's weakening growth prospects. This is the big elephant in the room. So which Chinese equities, if any, do you currently prefer?
Well, we think the market's clearly quite pessimistic on China and very much more focused on the near term. And economic history shows us that countries go through cycles, that China is no different, and China has been quite effective at managing outcomes domestically. This leads us to the conclusion that the market is being too pessimistic on China. We look through the short-term earnings cycles of companies and focus more on the medium to long-term earnings cycles, and hold at stocks for an average of 3 or 4 years. And over this investment horizon, we think there are some very interesting opportunities in China, and that leads us to be overweight China versus the emerging market index. At a portfolio level, we're quite diversified within China. We hold stocks across the sectors, but we have an overweight in industrials and energy sectors, and we have less exposure to communication services and consumer discretionary stocks, as some of these stocks are still overpriced in our view.
What can we say about the equity valuations in emerging markets? So where are they on a historical base after the losses of the past months? And where do you currently find interesting value opportunities in emerging Asia?
Well, we think about global markets as a single market and don't sort of necessarily break it into the 3 regions. But on a regional basis, emerging Asia does look cheap versus its own history and versus other regions on a price to book basis. But on a price to earnings basis, actually, emerging Asia looks a little expensive versus LATAM and EMEA. At the moment, while we're very much bottom up in our approach, we are underweight Asia relative to the index. That's largely driven by being underweight in India and Taiwan, that we think look a little expensive relative to other parts of the world. We actually find more opportunities in LATAM at the moment, where we're quite overweight. Having said that, within Asia, we do see or find good and attractive investments, clusters of stocks in places like China and South Korea. And at a sector level, we like stocks in financials, industrials, and energy across the whole of the region.
So this was Sam Bentley from Eastspring Investments. Thank you very much, Sam, for being with us today and sharing your views on emerging markets equity.
Thank you.